The official account of the 2008 financial crisis was settled quickly, and it was settled in a way that served everyone who needed settling. Reckless borrowers, irresponsible banks, a failure of regulation, a once-in-a-generation storm that nobody could have predicted. By 2009, that version was already calcifying into textbook certainty, repeated by finance ministers, central bank governors, and the editorial boards of every major newspaper that had spent the preceding decade celebrating the very institutions they now condemned. The language of accident displaced the language of design, and the financial record, which tells a different story, was never placed beside the official one in any forum that the general public was expected to reach. What the record shows is not a storm, it is an architecture, a set of instruments, ratings, regulatory decisions, and institutional arrangements whose combined effect was not merely foreseeable, but, in several cases, was foreseen by the people whose firms were positioned to collect when the structure gave way. The question the standard account was never designed to answer is not what went wrong. The question is what went right, for whom, and on what timeline. The two are not the same question, and the financial record makes that distinction visible in a way that the political account was designed to prevent. The architecture had a construction period. It had named architects. It had a commissioning body, and it had a set of beneficiaries whose identities can be read off the ledger of what the rescue operations paid out in September and October of 2008. The crisis did not arrive without a history. It arrived as the conclusion of a history that the standard account begins too late to contain. If you start the story in 2007, when the mortgage market began its visible deterioration, you find a tale of excess and poor judgment. If you start in 1999, when the legislative infrastructure that permitted the excess was completed, you find something with more precisely identifiable causation. The financial thread goes back further still, to 1980, to 1984, to the sequence of regulatory decisions that together removed the constraints the 1930s had built. That thread is what the ledger shows when you read it from the beginning. If you're enjoying this story so far, don't forget to hit the like button and subscribe. Drop a comment telling me where in the world you're watching from. I love hearing from you. To understand what was built, you have to go back further than 2008. You have to go back to the 1980s, when the first structural decisions were made that would take 2 decades to fully detonate. The Glass-Steagall Act of 1933 had separated commercial banking from investment banking for 50 years. The logic was direct. A bank that holds depositors' funds should not be permitted to use those funds to speculate in securities markets. The lesson of 1929 was that when those two functions merged, the losses flowed in one direction and the depositors absorbed them. Glass-Steagall was the wall built between those two rooms. For 50 years it held. The process of removing it began not in 1999, when the Gramm-Leach-Bliley Act formally repealed it, but in 1980, when the deregulatory climate shifted the regulatory philosophy at the Federal Reserve and the Office of the Comptroller of the Currency. Through the 1980s, regulators began granting exceptions. Banks were permitted to derive increasing percentages of their revenue from securities activities. By the time Congress voted on Gramm-Leach-Bliley, the wall had already been dismantled piece by piece over 2 decades. The final vote was a legal acknowledgement of a demolition that had already occurred. The act passed the Senate 90-8. The debate on the floor lasted 3 days. The structural consequences took 9 years to arrive. Between 1997 and 1999, the financial services industry spent approximately $300 million on lobbying and campaign contributions related to Gramm-Leach-Bliley. Citigroup alone spent more than $100 million lobbying in the 2 years before the bill passed. The Center for Responsive Politics documented 270 commercial banks, 285 securities firms, and 350 insurance companies as active lobbyists on the legislation. The number of registered lobbyists working on the bill exceeded the number of senators who voted on it. The financial institutions that lobbied for that repeal were the same institutions that would later require federal rescue. Citigroup, whose formation through the merger of Citicorp and Travelers Group in 1998 had technically violated Glass-Steagall, received a temporary waiver from the Federal Reserve while the legislation was pending. Sandy Weill, the architect of that merger, had spent years cultivating the political relationships that made the waiver possible. The Federal Reserve granted it. Congress then made it permanent. Citigroup would go on to receive $45 billion in direct capital injections from the Treasury during the 2008 rescue, with an additional $306 billion in asset guarantees. The institution whose formation had required the law's repeal was the same institution that required the largest rescue in the program. That is not coincidence. That is the financial thread. This is the pattern the financial record shows when you place the legislative timeline beside the institutional balance sheet. Each decision that removed a constraint on financial activity was followed, with a lag of years, by the expansion of activity into the space that constraint had previously occupied. The removal of Glass-Steagall created the space for the universal bank, the institution that could originate a mortgage, package it into a security, sell that security to a pension fund, and collect fees at every stage of the transaction. The universal bank was not a byproduct of deregulation. It was the product the deregulation was designed to create. The mortgage market that fed the crisis was not a spontaneous development. It was the output of a credit machine that had been deliberately constructed. At the center of that machine were the private label mortgage-backed securities that the major investment banks began issuing in volume from approximately 2003 onward. These were not the agency securities issued by Fannie Mae and Freddie Mac, which carried an implicit government guarantee and operated under their own, differently inadequate, oversight framework. Private label securities carried no such guarantee. They were rated by Moody's, Standard & Poor's, and Fitch, and those ratings were the mechanism through which the machine operated. The rating agencies occupied a structural position that has no parallel in any other corner of the financial system. Their ratings were not optional commentary, they were regulatory infrastructure. Capital requirements at banks, insurance companies, and pension funds were tied to the ratings their holdings carried. A bond rated AAA by one of the three major agencies could be held at minimal capital charge. A bond rated below investment grade triggered capital requirements that made it uneconomical to hold. The rating in practice was the permission to buy, and the rating agencies were paid by the issuers whose securities they rated. The conflict at the center of this arrangement was not hidden. It had been discussed in financial literature since the 1970s. The issuer pays model had replaced the investor pays model during the 1970s, partly because photocopiers made it possible for investors to reproduce ratings without paying for them, destroying the subscription revenue that had previously funded the agencies. The shift was practical and logical in isolation. In the context of structured finance, where the complexity of the instrument made independent verification by the buyer nearly impossible, it was something else. It made the rating agency's revenue dependent on the volume and rating level of the securities it certified. The more securities it rated and the higher the ratings it assigned, the more it earned. The model's incentive structure was not ambiguous. Between 2002 and 2006, revenue at the three major rating agencies from structured finance products grew at more than twice the rate of revenue from traditional corporate bond ratings. Moody's revenue from structured finance went from approximately $200 million in 2001 to more than $900 million in 2006, comprising roughly half of its total revenue. Standard & Poor's structured finance revenue followed the same curve. The business model of the agencies had been restructured around a product class whose ratings would, in the event of a housing downturn, prove to be the most consequential misrepresentation in the history of credit markets. The agencies were not ignorant of this risk. The record shows they were aware of it, discussed it internally, and continued issuing ratings whose volume the discussion had not slowed. From 2003 through 2006, the three major rating agencies assigned AAA ratings to the senior tranches of residential mortgage-backed securities at a volume that the historical performance of those instruments could not have supported. The models the agencies used to assign those ratings were based on historical mortgage default data from periods when house prices had never declined on a national basis. The models explicitly assumed that national house price declines were not a scenario that required stress testing. This assumption was not a technical error discovered in retrospect. It was a known feature of the models at the time they were being used. Internal communications at Standard & Poor's, released during subsequent congressional investigations, showed that analysts within the firm had raised concerns about the rating criteria for collateralized debt obligations as early as 2004. One analyst wrote in an email, later published in the Senate Permanent Subcommittee on Investigations report of 2011, that the rating agency would rate a deal structured by cows and would do it for the fee. The email was written in 2006. The ratings continued through 2007. The gap between what the internal record shows and what the public ratings certified is not a small discrepancy. It is the argument. The collateralized debt obligation was the instrument that amplified the mortgage market's exposure through the financial system. A mortgage-backed security pooled individual mortgages and divided the resulting cash flows into tranches ranked by priority of payment. The senior tranches received their cash first and absorbed losses last. The junior tranches received less and absorbed losses first. The AAA senior tranches of mortgage-backed securities were then pooled into collateralized debt obligations, which performed the same tranching operation a second time. The senior tranches of collateralized debt obligations received AAA ratings because the models assumed the underlying pools were diversified enough that simultaneous default across multiple securities was statistically remote. The assumption of diversification required that the securities in the pool be exposed to different credit risks. In practice, the pools were composed of mortgage-backed securities backed by mortgages originated during the same period, in the same geographic markets, by lenders operating under the same loosened underwriting standards. The diversification was taxonomic. Geographically and temporally, the exposure was concentrated. When the housing market began declining in 2006 and 2007, the correlation across the pools was near total. What the models had presented as diversified exposure proved to be simultaneous exposure at a scale the AAA ratings had explicitly ruled out. The investment banks that structured these instruments were not passive. They maintained trading desks that held positions in the securities they created. Goldman Sachs, beginning in late 2006, began reducing its net long exposure to mortgage-backed securities and building net short positions through credit default swaps. A credit default swap on a mortgage-backed security was, in economic terms, an insurance contract. The seller of protection received periodic payments. If the underlying security defaulted, the seller paid the buyer the face value of the security. Goldman's shift from net long to net short over the course of 2007 was documented in the Senate Permanent Subcommittee on Investigations report published in April of 2011, which devoted 240 pages to Goldman's mortgage activities. The report documented that Goldman structured and sold mortgage securities to clients while simultaneously holding short positions that would profit from those securities' decline. One transaction, the Abacus 2007 CDO1, was structured with the involvement of the hedge fund Paulson & Company, which selected mortgage securities it expected to decline for inclusion in the collateralized debt obligation and then took a short position against the security. Goldman sold the long side of Abacus to investors without disclosing Paulson's role in selecting the underlying assets or its short position against them. The Securities and Exchange Commission charged Goldman Sachs with fraud in April of 2010. Goldman paid $550 million to settle the case without admitting wrongdoing. It was the largest penalty the commission had imposed against a Wall Street firm at that time. If you're hooked on this story, make sure to subscribe and turn on notifications so you never miss an upload. Your support means everything and helps me bring you more emotional stories like this one. The regulatory apparatus that was meant to constrain these activities had been systematically reduced in the years before the crisis. The Securities and Exchange Commission's net capital rule, which limited the leverage that broker-dealers could employ, had been modified in 2004 following a request from the largest investment banks. The modification allowed broker-dealers with net capital above $5 billion to use internal models to calculate their risk-based capital requirements. The 5 firms that received this exemption were Goldman Sachs, Morgan Stanley, Merrill Lynch, Lehman Brothers, and Bear Stearns. By 2007, Bear Stearns was operating at a leverage ratio of approximately 33-1. Lehman Brothers was at 31-1. At that leverage, a 3% decline in asset values eliminates equity entirely. The Federal Reserve, under Alan Greenspan's chairmanship, had consistently declined to use its authority under the Home Ownership and Equity Protection Act of 1994 to regulate mortgage lending practices. That authority was explicit. The act had been passed following congressional hearings on predatory lending practices in the early 1990s. It gave the Federal Reserve the power to prohibit mortgage lending practices it determined to be unfair or deceptive. Greenspan testified before the House Committee on Government Oversight and Reform in October of 2008 that he had found a flaw in the model. The model in question was his belief that the self-interest of lending organizations would protect shareholders and equity. He called this a mistake. The congressional record through the 2003 to 2007 period shows 8 separate written requests from consumer advocacy groups, state attorneys general, and members of Congress asking the Federal Reserve to exercise its regulatory authority over mortgage lending. The Federal Reserve declined each one. The Treasury Secretary during the critical period of the crisis was Henry Paulson, who had served as Chief Executive Officer of Goldman Sachs from 1999 to 2006. The President of the Federal Reserve Bank of New York, which was the operational supervisor of the largest financial institutions and the primary counterparty in the rescue operations that followed, was Timothy Geithner, who would succeed Paulson as Treasury Secretary in 2009. The chairman of the Federal Reserve was Ben Bernanke, a scholar of the Great Depression, whose analysis of that event had led him to the conclusion that the Federal Reserve's failure to provide liquidity in the early 1930s had transformed a financial crisis into an economic catastrophe. Each of these men approached the 2008 crisis through the lens of the institution they had served or studied. The decisions they made in September and October of 2008 were legible in that context. The decisions they made about which institutions to save, and on what terms, were also legible in that context. The sequence of events in September of 2008 followed a logic that the financial record makes plain even where the official account presents it, as improvised response to unpredictable events. Fannie Mae and Freddie Mac were placed into government conservatorship on the 7th of September 2008. Lehman Brothers filed for bankruptcy on the 15th. The Federal Reserve and Treasury organized the rescue of AIG on the 16th, committing an initial $85 billion that would ultimately expand to $182 billion. The Reserve Primary Fund, a money market fund that held Lehman commercial paper, broke the dollar on the 16th, triggering a run on money market funds that the Treasury then had to backstop with a $250 billion guarantee on the 19th. On the same day, Paulson and Bernanke appeared before congressional leaders to request $700 billion in what became the Troubled Asset Relief Program. The decision to allow Lehman Brothers to fail while rescuing Bear Stearns 6 months earlier, and while preparing the AIG rescue the following day, was presented as a principled distinction rooted in the absence of a legal mechanism to rescue an investment bank. The record is more complicated. The Federal Reserve had extended its lending facilities to non-bank institutions for the first time in March of 2008 to facilitate J.P. Morgan's acquisition of Bear Stearns. The legal authority that had been absent in March was reconstructed by September. The decision on Lehman appears in retrospect to reflect judgments about which institution's failure was manageable and which counterparty exposures mattered most to the firms the rescue was designed to protect. AIG's rescue is the transaction the financial record examines most closely. AIG Financial Products, a subsidiary of the insurance holding company American International Group, had sold credit default swap protection on approximately $500 billion of multi-sector collateralized debt obligations by the end of 2007. As those securities declined, AIG was required under the terms of its swap contracts to post additional collateral. The collateral calls consumed AIG's liquidity, and when it became clear that AIG could not meet them, the Federal Reserve and Treasury intervened. The terms of the rescue required AIG to pay out its credit default swap counterparties at par, meaning 100 cents on the dollar, for securities that were trading at a fraction of their face value in the open market. The counterparties who received par payments included Goldman Sachs, which collected approximately $12.9 billion, Societe Generale, which received $11.9 billion, Deutsche Bank, which received $11.8 billion, and Merrill Lynch, which received $6.8 billion. The payments were made from federal funds without negotiation on price. Neil Barofsky, the Special Inspector General for the Troubled Asset Relief Program, examined the AIG payments in a report released in November of 2009. His office concluded that the Federal Reserve Bank of New York, under Geithner's leadership, had not required the counterparties to accept haircuts before receiving taxpayer funds. The report documented that negotiators had contacted the counterparties about accepting less than par, and that the counterparties had declined. The Federal Reserve Bank of New York then authorized full payment. The documentation trail ends at the authorization decision. Internal communications between senior Federal Reserve Bank of New York officials and the counterparty firms from the period between the 14th and 16th of September 2008 were not included in the public record. The gap in the documentary sequence covers the 72 hours in which the terms of the AIG rescue were set. What the next available document shows is a completed transaction at par. What occurred in between remains in the institutional record of the Federal Reserve Bank of New York, which has not been fully released. The congressional response produced a body of legislation, primarily the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, whose passage was presented as a structural remedy to the conditions that had produced the crisis. The act created the Financial Stability Oversight Council, established the Consumer Financial Protection Bureau, imposed new capital requirements on systemically important financial institutions, and introduced the Volcker Rule, which was intended to prohibit banks from engaging in proprietary trading. Each provision was subject to a rulemaking process in which the institutions the provisions were meant to regulate participated as primary commenters. The Volcker Rule, which in its drafted form banned banks from trading securities for their own accounts, took 4 years to finalize and was implemented in a form that contained exceptions broad enough that several institutions were able to continue trading activities that resembled what the rule had been designed to prohibit. The rulemaking record for the Volcker Rule alone runs to more than 18,000 pages of industry comment. The final rule is 298 pages. The exceptions are not footnotes, they are load-bearing walls. The 5 largest financial institutions in the United States held assets equal to approximately 43% of gross domestic product at the time of the crisis. By 2015, the 5 largest held assets equal to approximately 45% of gross domestic product. The institutional concentration that had made individual firm failures systemically threatening was larger after the reform than before it. The recovery that followed 2008 distributed its returns in a pattern that the financial record makes plain. Between 2009 and 2012, as unemployment remained above 8% and median household wealth declined, corporate profits recovered to pre-crisis levels and then exceeded them. The equity markets, which had fallen more than 50% from their 2007 peaks, recovered those losses by 2013. The Federal Reserve's quantitative easing programs, which involved the purchase of approximately $3.5 trillion in Treasury securities and mortgage-backed securities between 2008 and 2014, compressed interest rates across the yield curve to historically low levels. Low rates benefited holders of financial assets, whose values rose as the discount rate applied to future cash flows declined. They penalized holders of savings deposits, whose income fell as interest rates fell. The distribution of financial assets across income quintiles determined the distribution of that benefit. The Federal Reserve's own survey of consumer finances, published in 2014, recorded that median family wealth in the United States in 2013 remained 14% below its 2007 level. Mean family wealth had recovered fully. The gap between mean and median wealth, which measures how much of the total sits at the top, was at that point the widest in the survey's history. The men who had designed and operated the system that produced the crisis occupied the same or comparable positions in the years that followed. Lloyd Blankfein remained chief executive of Goldman Sachs until 2018. Jamie Dimon retained the chairmanship and chief executive position at J.P. Morgan Chase and was widely described as having managed the crisis well, having acquired Bear Stearns and Washington Mutual during the rescue period at prices that reflected federal support. Timothy Geithner served as Treasury Secretary until 2013 and subsequently became president of the private equity firm Warburg Pincus. Ben Bernanke received the Nobel Memorial Prize in Economic Sciences in 2022, in part for his historical work on the Great Depression and in part for his management of the Federal Reserve during the crisis. No senior executive of a major financial institution was criminally prosecuted in connection with the activities that produced the 2008 crisis. The Department of Justice reached civil settlements with the major banks between 2013 and 2016. Bank of America settled for $16.65 billion in 2014, the largest settlement in Justice Department history at that time. J.P. Morgan Chase had settled for $13 billion the prior year. Citigroup settled for $7 billion. Each settlement included statements of facts describing conduct that included misrepresentations to investors about the quality of mortgage securities. Each settlement was accompanied by a non-prosecution agreement. The conduct described in the statements of facts, had it been committed by an individual with fewer resources, would have constituted securities fraud under existing law. The distinction the Justice Department drew between conduct that warranted civil settlement and conduct that warranted criminal prosecution was never articulated in terms that survived scrutiny in the specialized legal literature, though it was not widely reported in the general press. The architectural record is what remains. What the record shows, taken as a whole, is a system in which every actor with the authority to constrain the machine chose not to exercise that authority, and in which every actor who warned that the machine was accelerating beyond its tolerances was either ignored, overruled, or absorbed into the institution they had questioned. Edward Gramlich, a Federal Reserve governor, warned Greenspan in 2002 about the predatory lending practices spreading through the subprime mortgage market, and asked the Federal Reserve to conduct lending surveys that would have documented the deterioration of underwriting standards. Greenspan declined. Gramlich later disclosed the conversation in a 2007 memoir published months before the crisis broke publicly. The memoir received respectful notices in the financial press and did not alter the trajectory of any regulatory decision. That is the admission buried in the archive, a regulatory official who saw the mechanism, named it, and was overruled by the man whose ideological commitments to self-regulating markets had already determined the outcome of the conversation. The record contains it. The standard account does not mention it. A regulatory decision made in 2004 that permitted 5 institutions to employ leverage ratios that guaranteed catastrophic failure if asset values fell by more than 3%. A rating system whose revenue model made the accurate rating of complex securities economically irrational for the agencies producing them. A set of capital adequacy rules that treated AAA-rated securities as low risk without examining the assumptions on which those ratings rested. An insurance company permitted to write $500 billion in credit default swap protection without the capital reserves that state insurance regulation would have required for comparable contracts. A central bank that had the statutory authority to regulate mortgage lending and declined to exercise it across a 4-year period during which the mortgage market expanded by trillions of dollars. Each of these decisions was made by named individuals at named institutions at specific dates that are part of the public record. The Securities and Exchange Commission's modification of the net capital rule was approved by the Commission on April 28, 2004. The vote was 5-0. The Federal Reserve's decision not to regulate mortgage lending under the Home Ownership and Equity Protection Act was confirmed in testimony by Greenspan before the House Banking Committee on multiple occasions between 2003 and 2005. The Gramm-Leach-Bliley Act was signed by President Clinton on November 12, 1999. The historical record of these decisions is complete, publicly available, and rarely discussed in the same room as the standard account of what caused the crisis. What the financial record shows is that the 2008 crisis was the outcome of an architecture assembled over approximately 20 years through decisions made by identifiable actors with identifiable interests. The architecture was not secret. Each of its components was debated in public forums, analyzed in regulatory comment periods, and challenged in congressional testimony by economists and consumer advocates whose objections are preserved in the congressional record. The objections were overruled. The instruments were approved. The ratings were assigned. The leverage was extended. The system still operates on the foundations that the post-crisis reforms left in place. The institutions that were too large to fail in 2008 are larger now. The credit rating agencies that assigned AAA ratings to securities that proved worthless still operate under the issuer pays model. The revolving door between the Treasury, the Federal Reserve, and the institutions they regulate still turns at the same speed. The quantitative easing programs that transferred wealth upward through asset price inflation were deployed again, on a larger scale, in response to subsequent disruptions. The populations that absorbed the losses of 2008 through unemployment, foreclosure, and the permanent reduction in household wealth that the Federal Reserve's own data recorded across the following decade have no more visibility into the next iteration of the architecture than they had into this one. The ledger from 2008 is not closed. The entries from the settlement agreements, the Inspector General reports, the Senate investigations, and the Federal Reserve's own post-crisis disclosures are all part of the public record. The question the financial record poses is not whether the crisis was avoidable. That question was answered by the people who tried to raise it at the time and were not heard, and by the institutions that positioned themselves to profit from the outcome before the general public understood that an outcome was already being priced in. The question the record poses is whether the architecture that produced it was ever actually dismantled, or whether it was merely repaired well enough to continue operating until the next set of entries appears on the same ledger. The documentary record does not resolve that question. It only makes the terms of it visible to anyone willing to read what the ledger actually contains, rather than the version that was written for public consumption in the months after the structure came down. Thank you so much for watching until the end. If you love this story, check out the other videos on your screen now. I think you'll really enjoy them. And don't forget to subscribe if you haven't already. See you in the next story.